I have developed a highly potent 3-step formula that I have personally backtested thousands of times. Every single month that I put this system to the test, it proved to be consistently profitable over the long term. The most impressive part, this strategy requires no lagging indicators and no complex chart patterns. We are talking about pure price action, baby. By the time you reach the end of this video, you will have fully mastered this strategy. You will be equipped to execute calculated trades just like the one I'm showing you and generate substantial profits. Step 1. The foundation of market structure. To dive right into the mechanics, the first step involves understanding market structure. This is arguably the most critical component of the entire formula. If you make even a slight mistake, just a tiny error, in this specific part, it will completely compromise the entire strategy. One of the very first things you learn when you begin your journey as a trader is the concept of uptrends and downtrends. It is essentially the sippy cup stage of trading education. A chart that consistently forms higher highs and higher lows is defined as an uptrend. Conversely, a chart that produces lower lows and lower highs is a downtrend. It sounds simple enough, and most people believe they have it figured out. However, what if I told you that you are probably identifying these trends completely incorrectly? The common trap of trend identification. Let's go back to our example to explain. In an uptrend, the chart moves upward, creating higher highs and higher lows. But then something interesting occurs. The price begins to head downward. In the process, the price drops and breaks right through a previous low. This exact moment is where I see the vast majority of traders make a fatal mistake. Because the price broke that specific low, many traders assume we are now witnessing a reversal and that the market has entered a downtrend. They immediately start searching for short positions, convinced that the price is headed much lower. But here is the reality: that chart is actually still fundamentally bullish. You see, while the price did break a low, that specific low was not actually a valid low, or at least not a structural one. How to validate a low? Why wasn't it valid? Because the price never broke the true valid low, which is located right here. You must understand that the only way a low becomes validated is if the price successfully breaks the previous high first. If the price moves in a way where it fails to break the previous high, any low formed in that process is invalid. I want to make this point crystal clear. In order for a low to be validated, it needs to break the previous high. If you do not grasp this specific rule, the strategy simply will not function. So, if the price successfully breaks a high, we now have a confirmed valid low. At this point, we are officially in an uptrend, which means we should exclusively be looking for bullish, long trade opportunities. The only time we should even consider looking for short trades is if the price breaks that specific valid low. The market can do anything it wants in between. It can go up, move down, or trade sideways. But as long as it does not break that valid low, we remain in an uptrend. Transferring your structural points. Let's test your understanding. If the price breaks a minor low, but that low never broke the previous high, what trend are we in? Most people would say a downtrend, but they would be wrong. Since that low wasn't validated, we are still looking at our previous valid low. Since that hasn't been broken, we are still firmly in an uptrend. Now, if the price eventually does break upward and clears the previous high, our valid low point is then transferred or moved up from the previous point to the newest one. I realize this can be slightly confusing at first, but the main rule to burn into your memory is this: a low is only validated if it breaks the previous high. If you remember that one simple rule, you will easily be able to identify whether you are in a bullish or bearish trend. That concludes step 1. Step 2. Identifying supply and demand. Once you have identified the trend, what comes next? That brings us to step 2, identifying supply and demand zones within the market. As a general rule, demand zones are found within uptrends, while supply zones are found within downtrends. A very effective way to think about this is that you want to buy from demand zones and sell from supply zones. The logic behind buying from a demand zone is simple. If we see a large, aggressive upward push from a specific starting point, it demonstrates that a massive number of people wanted to buy at that price. Therefore, we can assume that if price eventually returns to that area, traders will maintain the same mindset and want to buy in that same zone again. A supply zone is the exact opposite. If we observe a large downward move originating from a certain point, it proves that there is significant selling interest at that level. If price ever retests that zone, we can assume the price will once again face downward pressure. This supply and demand theory is the core of our strategy. Applying the knowledge to a real chart. We still have one final step in our three-step formula, but first let's put everything we have learned so far to the test using a real-life chart example. Looking at this chart, we see the price moved upward, retraced slightly, and then broke the previous high. This confirms we have higher highs and higher lows, meaning we are in an uptrend. Since we are in an uptrend, we are only interested in long trades. We do not look for any sell positions, as shorting during a clear uptrend is simply counterproductive. Since this specific low was the one that broke the previous high, it is our valid low. Price will only transition into a downtrend if it manages to break below this point. Now that our trend is confirmed, we search for demand zone opportunities. We locate these by finding areas of consolidation, points where the price moved sideways immediately before a sharp impulsive move upward. Marking your zones correctly. On this chart, you can see a period of consolidation right here before the price shot straight up. My preferred way to mark these zones is by highlighting the specific candle that occurred right before the impulse move. Grab your rectangle tool, find that consolidation area, and mark the previous candle from its low to its high. This is now our area of demand. Notice that we aren't even looking at supply zones right now because we are focused solely on the uptrend. We simply wait for the price to re-enter this zone. When it does, that is our entry point. Set your stop loss just below the demand zone and target the recent highs for your take profit. Boom. That's an easy, successful trade. The accuracy of trend following. To demonstrate just how accurate this strategy really is, let's break down another real-world sequence. Here, we have an uptrend where the price is making higher highs. We identify the valid low that broke the high. Suddenly, the price breaks below that valid low. Now, the market structure has shifted. We are officially in a downtrend. From this point on, we only look for supply zones or short trade opportunities. We mark our supply area, and when the price returns to it, we enter. We set our stop loss above the supply zone and target the recent lows. That's another easy win. But wait, the market isn't done. The price creates another supply zone further down while remaining in a downtrend. We wait for the retest, enter, and hit the target again. Then it happens again. Another supply zone forms. We wait for the price to return, set our parameters, and secure another winning trade. And then, believe it or not, it happens one more time. That is the true power of this strategy. It is extremely accurate, and because you are only trading in the direction of the dominant trend, your win probability increases exponentially. Step 3. The golden rule of risk to reward. Now that you see how powerful this can be, let's move to the third and final step to refine the strategy even further. This step involves risk to reward, R to R. Occasionally, you will find a trade that checks every single box in terms of structure and zones. However, when you set up your stop loss and take profit, you might find that it has a low risk to reward ratio. To maintain long-term profitability, we only take trades if the risk to reward ratio is above 2.5 to 1. This means that for every $250 we aim to make, we are only willing to risk $100. Even if the chart perfectly follows step 1 and step 2, we will skip the trade if the R to R is under 2.5. This single rule will increase the overall profit rate of your strategy by a massive margin. Final summary. Example. For our final example, we have a chart making higher highs and higher lows. We are in an uptrend, so we mark our demand zones. We see a consolidation phase right before a massive spike, so we mark that area. We wait for the price to return to the zone, and then we enter. We set our stop loss below the zone and our take profit at the recent high. The last thing we do is check our risk to reward. In this instance, it is a 3-to-1 ratio, which is well above our 2.5 minimum. We are good to go. We wait for the price to play out, and we get a beautiful winning trade. Now, all you have to do is repeat this exact process, forever.